Hey, everybody asks me about what is the easiest mortgage to qualify for, and I say, hands down, it's an FHA loan. Now, I'm going to explain everything you need to know about an FHA loan so you can buy a home and fire your landlord, qualifying, and everything you need to know with the whole home buying process, all in this one video. So here's where we're going to start. Everybody asks the same question. What credit score do I need? I know you need credit. Everybody knows that. Well, that's one of the reasons that FHA is so convenient. What do I mean by that? At a 580, that's pretty low FICO score. Only a 580, you can qualify with only 3.5% down. Forget the 20% down things. We're looking for loans that are easy to qualify for. If you had 20% down, we'd be talking a different language, different loan, different scenario. 580 FICO score, 3.5% down. If you're at 579 or below, below, sometimes as low as 500, it's hard to get approved that way. But 10% down if you're at 579 or below. Now, there are a couple of things that happen to people. Bad things happen to good people all the time. What I mean by that is, hey, financial tough times, if you've had a foreclosure or a short sale, on an FHA loan, 3 years must have lapsed. If you've had a bankruptcy, it must be only 2 years after the discharge, not when you file and apply. When it is discharged, the date will actually be on your credit report. Now, let's take a look at some other things. What do we need? We need the income. Now, there's a couple of ways we can do income. If you have a job, first of all, if you have an hourly job, if you work less than 40 hours a week, we're going to average over 2 years to figure out what your income is. If you work 40 hours a week, take your hourly rate, and what we're going to do is multiply it by 173.333, and that is how much you get per month. A lot of people say, well, I get paid 4 times every week, so that's 4 paychecks. No, it's actually 4.3 some odd number. So just use the formula that I just gave you, and we figure out what the monthly income is. If you have overtime or bonus or commission, what we're going to do is we're going to take that number, and it's going to be averaged over 2 years. We get a verification of employment form. We send it to your employer or the HR department, and they go through the numbers and they say, here's his base pay, here's his overtime or his bonus or commission, whatever it is, and we're going to average those other numbers over 2 years. Now, if you have a fixed salary every month, obviously that's pretty easy. Now, a lot of people are self-employed, and that doesn't mean you can't qualify. But what it does mean is you have to show how much money you make. Now, people say to me all the time, hey, Chris, I make $200,000 a year. And I look at their income taxes. Their accountant wrote off $190,000 so they don't have to pay a lot of taxes. Well, that means you only made $10,000, and you can buy a shoebox today with $10,000 a year. So you have to pay taxes, and we're usually looking at 2 years income taxes. Once in a great while, we can get away with 1, but it's usually 2 years income taxes for a self-employed individual on the profit that you pay taxes on. We're going to average that usually for 2 years. Now, what happens is you start by filling out an application. You need to be pre-approved. You can't go out and buy a house without being pre-approved because, 1, it wastes your time. 2, it wastes the real estate agent's time, and nobody works for free. If they're just out there showing homes and you're not even qualified, then guess what? The real estate agent works for free. They can't feed their family working for practice. So they need to know you're pre-approved. And we do that, we start with an application. It's a basic application that's going to ask your employment history. Now, we have to have a 2-year minimum work history. What does that mean? Well, if you're 19 years old, you got your first job at 18, and you've been working for 1 year, it's not enough. We need a 2-year history. An exception to that is if you have some kind of formal education or training, we can use that in lieu of the experience. Once did a loan for a nurse. She never had a job in her life. She went to college, became a registered nurse, and 1 pay stub, and we were able to close that loan. So there are certain circumstances where we can use the education, and we have to prove the education. We need transcripts. We need different things from the college. Or it could be, sometimes it's a certificate program. Hey, I went to school to become some kind of technician, and here's 1 year. We could use that in lieu of 1 year of school. So that's a big deal. Now, we need to fill out the application, we fill out what's the income. How much money do you have? Well, what do I mean by money? Well, you need the down payment. And we also have closing costs. So I'll talk about closing costs a little bit later, but we need the down payment. $500,000 loan. And some of you are watching from across the country. If you're here in California, you might be saying to yourself, hey, nothing less than $1 million in certain areas. And if you were in certain parts of the country, it could be $200,000. We're just using $500,000 to make it easy. $500,000, 3.5% down, because the FICO is over 580. We're talking at $17,500 down payment. Hey, that's not a ton. Forget about, like I said, the 20%. My job is to get you into your own home so you can fire your landlord. Now, we look at where did the money come from. Well, we usually ask for 2 months bank statements. We're going to ask for your 401k, anything like that. And sometimes people use the 401k. Sometimes they sell the extra car or the motorcycle or the jet ski that they don't use. Sometimes grandma can give you a gift. Yes, you can get a gift for the down payment and the closing costs. So that's a big deal. Hey, I wish I had a grandma like that. I love my grandma, but the money coming. Maybe you have one, so that would be great. We're going to take the money there. We're going to look at it. How much money goes? It's going to go on the application that you have. We have to prove every single thing. We got to prove your income. We run your credit report to see how much debt you have. And what we're going to do is we're going to evaluate how much income you have. There is a formula for the debt ratio. Now, if somebody makes $10,000 or a family makes $10,000 a month, I'm using the even numbers on purpose, you can go up to 47% of that for the house payment with an FHA loan. That's pretty good. It's pretty easy. Now, what I mean by that is $4,700 if the family income or whoever the borrowers are combined makes $10,000 a month, $4,700. Now, there's another number called the back end, and that's 57%. And that includes the house payment, the new house payment, and all your debts. What does that mean? Well, maybe your car payment's $500 a month. Maybe you have credit cards and student loans, child support, alimony, all these things. These are debts. Now, we're not talking about insurance and your cell phone and those kind of things. Those aren't debts. Those are money. You could shut those off tomorrow. You can't shut off your debts. So 47%, 57% with the debts. 57%, it's $5,700 of the $10,000. Now, what if you had $2,000 a month in debt? Because you have a car and your wife has a car and you have all these student loans and all these other things. Okay, this happens all the time. So $2,000, well, in order to stay under the 57% and the 47%, you can only go up to $3,700 on the monthly housing payment, and that other $2,000 would put you at 57. So you'd be 37.57. You know what's confusing? I'm a numbers guy. You can call me up. I can figure it out for you real quick and really. Now, we have to make sure the money is legitimate. And what do I mean by legitimate? It has to be. It can't be, hey, I got cash in the mattress. Okay, that doesn't work. Since the Patriot Act is a law, we have to prove where the money comes from. Otherwise, if you're depositing cash, we don't know if it came from Canada or El Chapo. We have no idea. We can't use money like that. We have to use proven money. If you have cash, call us. We have ways, we'll teach you what you need to do to get the money into the bank legally so that you can use it for the loan. They will verify where that money is coming from. So we'll take care of that. Now, we have on the application, we have how much money you have. We have your job history. How much money do you make? What does your credit report look like? And all these things, and we put them in this computer program. And it goes right through Fannie Mae or Freddie Mac's website. Basically, it's going to run right through their website and give us what we call a desktop approval, desktop underwriter approval, DU approval. And what's going to happen is, now we have an approval, I can do a approval letter, pre-approval letter, so you can go out with a realtor. Now, if you don't know a realtor, everybody seems to know a realtor. If you don't know them, I know the pros. Now, it's really important though. I don't want you to go to my buddy got his license yesterday. He can't legally protect you. He really doesn't know enough. I mean, we support family and all that type of thing, but this is the biggest purchase of your life. Never entrust the biggest purchase of your life to some rookie. So we're going to go through the process. We're going to tell the realtor, we have Harry approved for a $400,000 loan. And here's the purchase price on an FHA loan. And we're going to go out and show you properties. Now, as of August 17th, 2024, there have been some regulation changes. Maybe you've heard about them, maybe you haven't. But you're going to be asked to sign a letter with a form with the real estate agent. And he's going to ask you to sign this form saying you're going to pay him 2%, or he's entitled to 3%, 1%, whatever their number is. And that has to get paid. Now, is it going to get paid from you? Well, there's some creative ways that sometimes you don't have to do it. I got some pretty cool creative ways where the agent can get paid. You don't want to go to the listing agent and have that person represent you as the buyer. Why? Because a listing agent's fiduciary responsibility and who he has to protect is the seller. You want your own proper representation. And even more important than that, the agent that you have, you want him to be a superstar negotiator. The negotiations are the most important thing. Why? You may ask for closing costs. What is that? Well, first of all, let me get into the closing costs. I told you about that. And we have all kinds of things. We have processing fees and underwriting fees. Every lender has those. Some of them, they call them different things. Sometimes a funding fee instead of an underwriting fee, whatever it is. They have that. Now there's a title fee. There are title companies who ensure the title to the home is in your name. And we have escrow fees in many states. We have attorneys. They're a little more expensive, of course, but they both have a list of fees. They're not through the lender. They go direct to those companies. We have an appraiser. We pay an appraisal management company who pays the appraisal. We have 30 people who work on every transaction. We have the notary who's going to sign the docs with you. Sometimes they can come right to your house or to your job to sign. Well, they get paid for that. Nobody works for free. So we have all these different things. Then we have mandatory on an FHA loan. We must have property taxes and homeowners insurance included in the payment. Now, what that means is we have to set up what we call an impound account, an escrow account. They're both the same thing. What happens is, depending on what month of the year, and every state is different, counties are different. Here in California, in the month of September, you may have to pay 9 months property taxes up front. So the taxes are going to be due in a couple of months, and the lender is going to write a check, or send a wire, obviously, to the county for the taxes. We must have 1 year and a couple of months of homeowners insurance up front put in that impound account. That impound account is actually your personal savings account. You can't touch it. It's not like, hey, I want to go on vacation. You can't touch it. It's there for property taxes and homeowners insurance. Now, if you should sell the house or refinance the house, so pay off the loan, whatever money is in that impound account is yours. It comes back to you. That's how it always worked. That's how it does work. So mandatory on FHA. There's one more thing that's included in the payment. Basically, principal and interest of the loan. We have property taxes. We have homeowners insurance. We also have mortgage insurance. With conventional loan, it's called PMI, mortgage insurance. With a FHA loan, it's called MIP, mortgage insurance premium. And basically, it's with 3.5% down, it's just over 0.5% per year. Think of it this way. If you have a 6% interest rate, you're paying 6.55% because of the PMI. And some people say, I don't want to pay PMI. Well, then save 20% and you can do it differently. But otherwise, say thank you for PMI. Otherwise, most people wouldn't be able to buy a home. So we're glad to have it. We're also glad to get rid of it. Someday, maybe you refinance. If you have enough equity, you have the 20% equity, you can get rid of that PMI. So that's another story. So we have all these closing costs. You can have the agent ask the seller's agent, and it's got to be on paper, hey, can you pay $10,000 in closing costs? Now, a few years ago, this was very, very common. Today, it's a little harder to get, to be honest. And the reason for that is supply and demand. There's a small supply of houses. It's still a big demand. And if you were selling your house, you'd want $1. You wouldn't want to $10,000 away for no reason. But if you can get, or you have a good agent who can negotiate to get you some closing costs, hey, that'll lower it down. Some months of the year, you'd only need 2 months property taxes. Some months you need 9. So the closing costs can vary dramatically depending on what time of the year. And again, every state is different. So closing costs could be $10,000, it could be $15,000. And if we can get the seller to pay some of it, that's an option. Sometimes I can raise the interest rate. By raising the interest rate, obviously your payment is higher, but I can get a credit to help you with closing costs. So there's a lot of things we can do there that can be creative. The best option, though, is always, if you have the money, pay it yourself. You get the lower rate, you get the lower payment, you get everything like that. Now, people ask me all the time, hey, Chris, I am a first-time home buyer, thinking that there's some magic out there. Let me explain. First-time home buyer programs are wonderful for consumers who don't have the money and really don't have the opportunity to save the money. But if you have the money, and I'm going to show you why, you always want to do it yourself and pay it yourself. When I say there's no magic out there, just because you haven't owned a home before, like the tooth fairy, you tell your kid, put the tooth under the pillow, and he wakes up and there's $1 under the pillow, whatever it is today. What happens is a lot of consumers think that they can take like their rent check and stick it under their pillow, and they're magically going to get, the first time home buyer fairy is going to dump 15, 20 grand on. It happens. Where does the money come from? It doesn't come from some fairy. It comes from a much higher interest rate. So you're going to have higher payments, at least until you can refinance when the opportunity is right to do that. So if you can come up with the money yourself, you're better off. If you can't, hey, these programs are wonderful for a lot of consumers. Now, your agent takes you out, you and your spouse go out, you're seeing homes, and some of them are ugly, some of them are great, all of a sudden your eyes are going to light up. It's like, this is the one. Everybody has had that epiphany, that wonderful moment. Now, what happens is you go out there, you find the house, and the agent makes the offer and starts negotiating on your behalf. And when they reach a deal, we open escrow. In some states, it's called under contract, and you are required to put some kind of deposit. Sometimes it's 1%. Sometimes the listing agent wants 3%. They're just trying to gouge you. You're not paying extra, but that's a good faith that you're going to follow through with the deal, instead of just like, hey, I changed my mind, 30 days into the transaction. So you're going to put the deposit down, and we're going to open up escrow. Now, I'm going to take your file. The loan officer is going to take your file and submit it to their processing department and submit it to the underwriter. And first thing we're going to do is we're going to have disclosures. They're loan estimates. Basically, here's how much the fees are going to be. Here's how much taxes and insurance and all the different fees. There is no shortage of fees, but it's going to be an estimate. Now, at the same time, most of those fees, once you have an estimate, do not go up. So, because if they go up, the loan officer, the lender, has to eat them. So instead of giving you normal fees, and this is the government at its finest, we have to bump those numbers up just in case they charge more. They're out of our control. So the numbers are going to be artificial in the beginning, and you got to expect that. But your loan officer can explain it and show you what's probably high and what's not. Now, you signed the disclosures. Now we can really start the process. We sign the disclosures, and what we're going to do is we're going to order the appraisal. When appraisal is quite a science, it's not, oh yeah, I think it's worth it. They're going to evaluate like houses for like houses. The closer they are, it gives a more accurate representation of the value. Now, there's different types of condition of houses. There's brand new, and there's like new, and then there's left in, and then there's this needs work, and this is tear down. Okay, so we have different. The appraiser, if your house is in the like new, it's only going to compare to like new. If it only finds houses that are really lived in, well, then it's going to give you more value in comparison. So it's really a science. It protects you, the buyer, as well as protecting the lender. Because if you're buying a house for $500,000 and the appraisal comes in at $450,000, I don't think that's a good investment for you. And the The lender is going to say, we're not going to lend you $500,000 on a house only worth 450. So it protects everybody. So we use this as protection. It's a standard in the loan process. You can always get an inspection, $8, a few $100, $500, but a professional licensed inspector comes out and evaluates everything, the sink, the toilet, every little thing. Oh, there's a little bit of termite here, and there's so you go into a home. It's a good deal to spend that $500 or whatever it is, just to know you're buying a sound home. So we're going through all this process. We submit it to the underwriter, and the underwriter is going to look at the income, look at the assets, the money that you're putting down, look at the credit, look at all these things, look at your job history. And is going to usually request some extra things. Hey, I want a letter of explanation here. Hey, I didn't get it. What is this money that was deposited in the account book? Those kind of things. Very, very standard. And they issue the approval subject to certain conditions. For example, the letter and the different things that they want. And once that's done, they issue what's called a clear to close. Now, once we have the clear to close, we order a CD. It's called a closing disclosure, not the closing documents, closing disclosure. And remember the loan estimate from the beginning? Well, this is accurate. Now every single penny, it's down to the penny. This says how much money you need to wire into escrow, or your grandma or whoever, wherever the money's coming, how much goes into the escrow. Now we're going to take that money and we're going to wire it. Now, before you wire money, super important. You're gonna get an email from the escrow company or the law firm and whatnot. And it has happened before, and it actually happened to one of my clients. And what happens is sometimes the escrow company can get hacked. There are clowns out there who are thieves. And they got hacked. They knew that this client's email address and everything else, and they sent an email to him saying, wire the money to, and he wired a couple of $100,000. And it went somewhere in the Philippines. It was gone. So you never, ever wire the money just off an email. You call the escrow company, the law firm, whatever, and you verify that information is correct before you wire it. That's just a safety feature. I think it's important to know. Now you're going to wire the money, and 3 days must have elapsed after you sign the closing disclosures to sign the closing documents. You're going to sign all the documents. Get ready. Your hand's going to be falling off. You're going to be signing a stack of paper this thick. They're also going to give you a copy so you have everything there. And the next step is the funding department and escrow go back and forth. Okay, I got this money. I got that money. Here's how much we need. And they make sure everything matches perfectly. Once it matches perfectly, they fund the loan. Congratulations, that home is yours. But there's still one more step. The title company is going to go to the escrow company, is going to go to the county, and they're going to record the loan. And once we get confirmation of recording, what's going to happen is we're going to call you up and say, congratulations, you fired your landlord, you own your own. Now, if you'd like to find out more about how we do this, and if you'd like my book, I'm happy to send you my book. I have a digital book. I also have a print book, and it teaches you everything about the home buying process. FHA loan, if you're a vet, it teaches you about VA loans, conventional. It teaches you everything. What are all the closing costs? If you'd like a book, reach out to me. Okay, I'm happy to provide it, and I'm really happy to help you fire your